out as we go through their slides on their comments and discussion. I really look forward to hearing your insights and questions along these lines as well. And so I'm going to share a little bit of outlook, current conditions, a little bit of highlights of the COVID-19 impacts. And certainly it's an evolving situation and seemingly getting worse day by day, but we'll go through these slides, talk about some of these topics, some of them which you may be well aware of, but given your agenda, I'm not going to spend a whole lot of time getting started, but because your agenda is really full and really interesting. So let me just jump in on this presentation. You see this cartoon here. The cartoon's a couple years old now, but it points out a couple important topics that we'll address through this presentation. And you can see it's the common end of the year cartoon where the Father Time is switching off to the new year. As I mentioned, this was done in 18, handing off to 19 and what 2019 covered. But really, a lot of those issues took effect and accumulated in 2020 as we're working through right now. And one is those trade war effects and the free trade agreements that have been established and were just getting put in place when COVID-19 impacted the global economy. So those trade agreements, we'll talk a little bit about that as we move forward towards the end of the presentation. Even a couple years, there's higher U.S. interest rates and the role of the Federal Reserve, and I'll share a couple slides on impacts that you well know of, but I think are a little more alarming when you see the graphs of the extent of the changes. We won't talk much about Brexit as that's European and it really doesn't, on the West Coast, I just don't see much European influence on commodity markets. We don't sell a lot to them directly. So with those topics in mind, we'll move forward. And one of the things that's driving this that everybody needs to be aware of is the year-over-year increase in meat production through the system. So we are not running short of meat. And that's illustrated in this graph. Each of those commodities, beef, pork, chicken especially, have small relative percent increases. Beef and pork about 1%, chicken about 4% growth. So it's not an alarming growth, but it is increased supply coming into the production channel. And with that increased supply in the production channel, really the markets, there's really two markets. There's the domestic market and the export market. And the increase in supply was really dependent on the export market to move through the market channel. And when you've probably heard of Smithfield Foods and JBS closing their packing plants, that bottleneck with this record supply in the production chain, that really leads to some dramatic price dynamics, and I'll show you a couple graphs on that. So I ask you to keep this record supply growth in mind as it's driving markets, and it's going to drive impacts as we work through this and reopen the economy. This graph, just to put into impact, when you get, and talking about developing those export markets, those export destination countries have to have the ability to pay for the food. See United States and China and Japan, Mexico up at the top being relatively small, and you compare that. But those countries, those are our trading partners, that's the state of their economy. Their economy is also going to be impacted, so that's going to be a complicating factor as we move forward, and we just want to recognize who those trading partners are and their strength and ability to trade with us. Following or moving directly into the cattle market, I thought this might be a good way to initially look at it. One of the things on the left is the fall calving, and the right is the spring calving. And the dynamics of those two markets, I think, are really going to be important to look at. On the fall calving versus the spring calving, I don't know in Nevada the percentage breakdown, but in Washington, we know, we did a study, a survey, we know about 80% of Washington cow-calf producers are spring calving. That's fortunate for the spring calvers because hopefully that'll buy them some time before they have to convert their production to cash in the marketplace. And hopefully by fall, we'll be making recovery and well on the recovery, and this price structure would be back to normal. Fall calving, they're going to be weaning their calves in the spring. They're maybe looking right now to be weaning those calves. They're looking to convert those calves into cash, maybe cull their cows and convert to cash. Those group of producers are facing really significant challenges because they're going to have to decide what to do with those calves. And are they going to take them to market, or do they have opportunity to wean and graze them farther and hold on to them longer in hopes that the market's going to recover? I don't know how much risk management and the LRP insurance they had on their price to floor their price, but that's going to be an issue moving forward. So to put it in perspective, to go back on those spring calving, I tried to find this for Washington through the LMIC. They collect the state data. Wasn't able to do that, but I wanted to point out the relative magnitude of the fall. I don't know if your pictures are, or if you're on the right-hand side, if you're seeing that price figure that was close to closing. I think I pulled them off yesterday, actually, and it's about 127. That green line that's in that graph in the middle, it's about a 127, $1.27 per pound, or 127 per hundredweight. However you prefer to think of that price, but 127. And if we look at 127, and that was delivery in October, that would be a futures contract that you could execute today at 128. You'd have to evaluate your basis, etc. But 128. And in October in Washington, we have 2 years in 2010, 114, 2016, 113. So we've seen prices somewhat recently below where we're at now with the COVID market impacts. Certainly below last year at 147 versus 128, but just putting putting into perspective that the sky is falling in the beef market where it is today. Certainly that loss in value is important to those producers, but that's the relative magnitude of where we're at right now. In talking about those fall calving and what they have to work with, this is the April 7th drought monitor. Looking at Nevada, that's showing some evidence of drought. The S indicates short-term drought, so just recently developing over quite a bit of Nevada. You guys are there. You guys will know what resources and forage resources are available and what might what advice to give to those fall calving operations. But that's going to be a factor. I also I don't have a graph on the snowpack, but I looked at Nevada's snowpack, and I think the news was that your March storms really helped that snowpack level. improve a little bit, but the drought, what the drought is going to be through the summer and what options they have for that is going to be important. And also not only for those fall calving operations, but for those feedlots that manage their inventory on their placements coming in, they may be able to delay them and work that production chain as they see fit relative to the price risks that they're having. Okay, any questions or comments? Again, please shout them out. This series of graphs is really interesting as to what the current uproar is about on wanting to investigate price impacts. The NCBA, National Cattle Beef Producers Association, they're calling for price investigation, and it's really quite interesting on the dynamics behind here. So let's start looking at this, and why don't we just start with the current and looking at what the issue is. And so if you look on the upper left-hand corner, the box beef cutout, I don't know how versed the audience is on box beef, but box beef is the value of the beef coming out of the packing plant or slaughter plant. It represents the entire carcass. They do calculations, and so that's the value of the carcass coming out of the beef plant. And that's the 2020s, that blue line, what we saw. And so as COVID-19 impacted the market, what they saw was a dramatic increase, an increase of 25% in the value of the beef coming out of the packing plant. And then you turn your attention, let's turn our attention to the right on the slaughter steer prices. The slaughter steer prices for 2020, you see in that blue line on the left, you see that really strong decrease in slaughter price, which is the value of the animal entering the slaughter plant. And so the cattlemen are quite upset about the price falling for the value of the animals entering the packing plant when the packing plant's value coming out is increasing. And they feel that's unfair and that the packing plant's exerting price manipulation on that and are extracting profits. And that's not unique. If you look at the red line in that box beef cutout, plus 12% over 7 days in 2019 at the end of the year in August. And that market shock was Tyson beef packing plant having a fire in Holcomb, Kansas. And it was a large packing plant. So people had to redirect their finished steers, animals into different areas. And it was the same argument on price fixing in August 2019 that's being raised again in 2020 with COVID. And so the economists are going to be charged with investigating that price investigation. I think there's been claims made on that price investigation, but really it's the dynamics of the market chain, how much free beef is moving around relative to not being contracted. Most everything has a home once it enters the packing plant. It's been contracted 2 to 3 weeks in advance. And that's how that supply chain has worked. And so, but that's when you talk about what's happening in the marketplace, that's the current issue being addressed. What's really interesting, and hopefully maybe a silver lining as we move out of this and reopen the economy, is this bottom graph on the left on the percent share and cutout value moving to the chuck and the round. That chuck's the red line, the round's the gray line. and they've seen increased values because as people stay home and redirect their shopping and cooking and providing for their family, they're discovering the roasts and cuts in the chuck and the round to increase those values, even increasing the value, the contribution to the whole animal, even eclipsing that of the loin, which is not common. So hopefully a golden thing that we can hope for is that that market dynamic extends beyond COVID-19 and people rediscover that value of beef and reinvest in that. So that's I don't know if I did put packing plants closing, but that's certainly the big issue facing the bottleneck, as I mentioned before and repeating, is the packing plants, the production bottleneck. And if COVID-19 shuts that down, hopefully it'll be a short-term shutdown and we can get back to normal, but that's going to be really the impact to the market as we go forward. But it's not because of a supply shortage, going back to that first graph that we talked about. For dairy's facing the hardship that fall calving beef producers are facing is that they're delivering milk into a declining market. And this is just a milk class 3 futures contract reflecting current cash prices and the declining current cash prices on the dairy industry. The dairy industry, if we look at the top of the graph, if we look at 2020, starting at 2020, and then you can see that price peak up to about 18 and then holding up around 17 and $18. That was the first good price improvement that went back to the producers that drove their price over 20. Class 3 is for cheese, and it's a lower class when you include the usage for milk, and that increases the farm level price to about 20. And that was the first time it's been above 20 since 2014, or the first time in 5 years. First time in 5 years that they had some price improvement, and the dairy industry was really looking forward to getting some price break and getting some profitability back into their operations and paying down debt. So the producers, they've really had a knee-jerk thing. They had some optimism at the start of the year, and that optimism really has been deflated, as you can see that downward line, which is really depressing. You can see I put in the bullet points why that dairy demand has shifted. The closed schools, on the news this morning, they talked in New York alone, 1 million kids not being in school. And the dairy products that go through those school programs is enormous. And so I'll conclude on the dairy outlook with the bottom bullet point is, do they have enough equity to increase debt? That's the one thing everybody's going to be moving forward to as you look forward to everybody in Nevada recovering from this, not only through the agriculture sector, but through all sectors, is their ability to borrow to meet the cash flow constraints that they're going through now. And as I mentioned, with dairies over the past 5 years having very poor profitability, they may not have enough equity to increase their debt load to work through that. So the dairy industry, which is important to Nevada as well as everybody else in the West Coast, that's going to be the highest risk commodity because they've had problems recently. Move to hay. And you can see the hay price, and I pulled that from Nevada from the USDA. And you can see that the issue with the hay price is that the USDA does not want to set the market. Had this conversation a couple times with them, is that you can see very sticky prices reported in 2019 in the orange, very sticky in blue, 2018. And so they are not very, there's a lot more price dynamic than are illustrated in this graph just by the way the USDA collects and reports this information. But currently, the hay market has not crashed. The hay market is holding up probably better than most commodities. But the point is that it's not being tested because the new crop isn't coming to the market. But when you look at the outlook for the drivers on the hay price, with the milk price, we looked at the milk price. Dairy isn't going to drive exports, or I mean drive prices. Exports are pretty good. I think I have a, do I have a comment? I think the next bullet talks a little bit more on the export, so I'll expand on that. I threw horses in there. That people have the capacity to purchase hay for their horses. Hopefully that'll continue on, but they don't buy big bales, and they don't contract for big volumes. But importantly, the damaged low quality to feedlots, that's a very important market outlet. Feedlots are going to be looking for cheap feed. Corn is currently cheap. Ethanol is down, so there's corn's available. So hopefully the feedlots will have ability to keep pulling that low quality hay out of their market. On the current export data, January and February are available. The hay exports are up on that. China bought a big volume of hay that pulled it out as this was going. Decreased alfalfa to Saudi Arabia, big important, but they come in and out of the hay market, and they may be down. Everybody's looking, oh, where's Saudi Arabia in the market? But they jump in, and they have the capacity to jump in and out and make impacts to the hay market. But those exports currently are current. But the bad news is in this next bullet point, and that's bad news for hay and the economy. Canceled sailings due to weaker demand for Chinese goods to the West Coast. And I think they came out with the retail data into this morning's news. You've probably heard that decrease. But what's important on the hay is that the hay export market really developed on the backload transportation out of those containers back to China. Because they were able to contract those containers at a low rate. If those sailings have gone down, those containers are going to be harder to place on the ships that are sailing. Not good news for hay because they have low ability to, it's a low margin business. The hay exporters are going to be carrying a lot of risk. That's not a good sign. On the hay acres, down 3% in the West, up 1% in Nevada. Not a big shock. Everything, it's what's going to drive that market is the no really supply shocks. It's going to be the weather and the water availability through the growing season. And so the bottom point, you've seen the downside risk on all the other commodities. The hay market's currently holding steady, but it's full of downside risk, and those producers might well want to look at forage insurance or whole farm revenue as a floor for them, as that they can put into place now. The couple, I'm losing track of time. I don't want to take a lot of your time, but I think these are really interesting and moving forward as we conclude. I don't have too many more slides. I think it's worth taking the time to look at these slides to put in perspective where we're at from some macroeconomic perspectives. And this ties back to the interest rate in that cartoon. And if you look at this graph, Federal Reserve assets as a percent of GDP, the Federal Reserve really didn't have a lot of assets on their balance sheet. But in 2008, that was when the real estate mortgage crisis hit. And so they bought those junk mortgage bonds and put them on their balance sheet. And you can see that jump up to 15% with some trending upwards and a shock up into 2015. But they were selling those and they were maturing. the economic question that was being debated was, do we sell those into the market? Because if you sell that junk into the market, it has to be sold at a risk premium and it has to drive the interest rates up. So there wasn't a lot of incentive to drive those poor assets or drive those assets into the market. So a lot of people were saying, well, just hold on to them and let them mature and let them expire and we'll grow out of it. You can see that balance sheet that was going down, but in 2019 COVID, they had to jump in the market again. They had to jump in and buy junk bond assets and junk bond stocks to put a floor under the stock market crashing. And you can see that's going to be a major, I don't know, challenge or issue underlying the economy as we roll out of this. As to what's the Federal Reserve? I mean, are they truly a bottomless provider of money into the economy? And talking about money into the economy, we talk about the deficit. And here's a graph on the deficit spending annually, and you can see the dramatic decline projected for 2020 and 2021 even further, as money is being injected into the economy through unemployment, through the stimulus checks that are in the mail now, and likely stimulus monies being developed to put people back to work. But the deficit is going to be huge, and probably for the audience talking here, even more so, because I believe a lot of you are county and state managers, probably under a balanced budget law, and that's going to be a real challenge that you'll have to address moving forward. Is to, are we going to balance the budget? Are we going to allow a relaxation of that law to take on some deficits? That's going to be a challenge to keep people in work moving forward. Quickly on the phase transition that I took, we talked about reopening the economy and building, and this is just one graphical explanation that you can look at that has some interesting things for you to consider on the steady state equilibrium of the economy growth and unemployment being low prior to COVID. The cascading network collapses, the supply chain collapse, starting with China as they locked down in January, impacting the auto supply chain dramatically. That restructuring due to the financial stress and rebuilding, and that could be important because I read one news article that China is producing most of our antibiotics in the medical community. We've seen the medical community supply chain being dramatically impacted. I'd imagine as we rebuild that, there's going to be opportunities in that supply channel for U.S. firms to jump into it. And then what happens as we come out of it in the green line? Certainly some optimistic thoughts that green line is going to be an increase, going to be much steeper than that, and that recovery is going to happen quicker and better. Or in this article that you can reference, they think it's going to be slower than what it was before. So we'll see how that comes out. It's going to take a lot of leadership all across everybody contributing what they can into those challenges. I'll just go into the trade, and then I think the next one's the conclusions, and I'll stop taking your time. But the trade deals are Japan in October 2019, the Mexico-Canadian agreement January 29th in 2020, and phase one of the China deal, which has a lot of generated a lot of optimism for the agriculture community. And just share a few of the details in case you haven't seen these on what that phase one agreement was. And the important thing is that they base everything off of the level of trade in 2017 and then increasing into the future. Part of the commitment was an 80 billion commitment towards agriculture commodities, 40 billion annually. And so we want to put that in perspective. It's not a jump of 40 billion. It's a jump to 40 billion from where we were in 2017. And in 2017, agriculture imports to China were 24 billion from the United States. And so what it is that 24 billion is the base. We were going to see a 12 billion increase in 2020. Saw some positive impacts of them buying alfalfa into the alfalfa market, pulling those exports up already. The third bullet is the discussion. There was discussion whether it was feasible. One thing on the feasibility is in the italics is that the tariffs that were in place prior on agriculture commodities remain in place. So that pricing impact and that negotiation on who's going to pay for those tariffs is still ongoing. And I think what's important to point out as the bottom bullet is that China's ag imports were estimated to be 124 billion in 2018. And so if we're going to be 40 billion from the United States, that's certainly within their budget historically. It just means that they're going to redirect where they purchase their goods to the United States, and it's going to hurt other countries and market share loss. This is my last slide. Just everybody well knows it's obvious to point out the economic devastation that's ongoing. Tom pointed out earlier that it's until there's a vaccination or a foolproof treatment that is going to linger because consumers are going to be afraid, just as Tom pointed out. I mentioned that the shipping capacity, that's certainly a leading economic indicator on where things are going. And just point out that the loan programs, the Paycheck Protection Program that's been announced but hard to get into, that's certainly an important program. FSA Guaranteed Farm Program, they're geared up to make those guarantees to provide equity under that guarantee if needed. So that's an important program. You're probably aware of that. And ongoing, I put forthcoming USDA support, but there's also state programs that are going to be introduced as well. So we'll have to keep aware of those and educate producers on what opportunities may develop through those programs. And that's my contact information. Happy to follow up with anything or any questions, or if anybody has any data or requests or anything on that. So thanks, Stacy. I lost complete track of time but hopefully I'm not too much longer, but thanks for the opportunity.
Great. Do we have real quick any questions for Shannon? I can tell you in talking with one of our hay buyers in the Western Nevada, he concurs with everything that you said, that China is buying the cubed alfalfa hay, but he's having trouble with the docks and the shipping. So he said if he can get it through the ports on the West Coast, that they're able to get it into China, but that's becoming more and more of a problem.
Yeah, hey Shannon, this is Tom Harris. I agree what you've done, but there's also this macro stuff. I think it's very on the finance. We collapsed during the last 2008, and I'm in economics. And there's a guy that does macro, Federico. And I was talking to him, what's this new monetary theory? And it's all just you expand. And he made a good comment to me that everybody who's 55 and under never has experienced inflation. You know, when I bought my house in the 80s, I had 15% interest rate. Unfortunately, I think a lot of our young decision makers have never seen inflation, and this can come to bite you because you're not aware it could happen.
Well, absolutely. We could talk about inflation on toilet paper even, or on milk. And even inflationary factors on that boxed beef. They're unique market factors that drive and take advantage of that demand. And but what as you mentioned, inflation is more of a widespread economic phenomena infecting not just one commodity, but all commodities. And yeah, it's I've never lived in a hyperinflationary country. I don't think I've even visited hyperinflation. I've been to Argentina that's battled that in the past, but yeah, that's that would be insidious.
Okay, I think we're gonna move on. Thank you so much, Shannon, for being on this morning. We're gonna move on to see if Tom and Mike and Malika have any updates from the FAPRI program.
Yeah, we're trying to, the more information our producers have, the better. I mean, something from Shannon's, I mean, put it all together. We need as much info because of changes are going on. And yeah, Mike and Malika doing the same thing. We're trying to work, you know, I'm in the business school, so I'm trying to put these things on the business school web as well as the extension web, because business is a business audience in the state to be aware of what's going on in the ag sector. I think what we have here is I like those videos. We can have as many people developing different things for different kinds of those. Stacy, you want something, I want something, good.